In a crisis, the only thing you truly own is what you can hold, control, and access without permission. When people hear gold or silver, well, they often think that it's all the same. You first need to understand what real money looks like. Precious metals come in very different structures, each with its own level of control, counterparty risk, and vulnerability or not to the system. What you're looking at here is the real story behind all the headlines. This is the purchasing power of the consumer dollar, and it's been in a controlled demolition for over a century. Now, this particular chart shows the most recent leg of that decline, but the pattern is the same. Every year, your dollars buy less and less and less, not because of anything you did wrong, but because the system is built this way. Inflation isn't an accident, it is a policy. And when the value of the currency erodes, your labor, your savings, and your future, well, they erode right along with it. And that's why I say the system is failing, not because it's broken, but because it's doing exactly what it was designed to do. We're just at the end of this. So to understand fully how to protect yourself, you first need to understand why the dollar is losing value and what real money looks like. Because when people hear gold or silver, well, they often think that it's all the same. But like the dollar has different forms, physical cash, bank deposits, digital entries, precious metals come in very different structures, each with its own level of control, counterparty risk, and vulnerability or not to the system. Some forms give you sovereignty. Others keep you trapped inside the very system you're trying to protect yourself from. And if you don't understand the difference, you can end up thinking you're safe when you're actually still fully exposed. So let's break this down. And we're going to start with the most fundamental distinction, what it means to own gold and silver inside the system versus outside of it. Because most people who think they own gold or silver, no, actually they don't. What they own is a paper contract, a claim, an IOU, as it were, a promise that the metal exists somewhere. But frankly, promises are only as good as the system backing them. And we just saw that what the system is doing, well, it's declining. And so paper metals are designed to give you the illusion of ownership while keeping you inside the financial structure. Yeah, they're easy to create, easy to rehypothecate, meaning use that collateral over and over and over again, so it's really quite leveraged, and easy to freeze. Nope, you can't have it. And in a crisis, the only thing you truly own is what you can hold, control, and access without permission. Because frankly, it's true. If you don't hold it, you don't own it. And so when we're looking at the spot gold contract and we're thinking that that's gold, I want you to think about what that contract controls. Because quite honestly, that whole trend is shifting. We've been talking about it all year long, starting really January of 2025 from the contract market like we're looking at over to the physical market. But let's stay with contracts for a moment because you can see that they actually control, they've got a foot in the physical, but mostly what they control is the intangible, the digital. So let's look at the most common form of paper metals, the one most people buy without realizing, you're still trapped in the system. This is the GLD, the gold ETF. Because when people look at gold, they usually look at the spot price and that number on the screen, but that number doesn't tell you what form of gold you actually own. It doesn't tell you whether you have something tangible, something deliverable, or just a trading contract that can be created with a keystroke. Well, the market lumps it all in one, all together under the word gold, but they couldn't be more different. Physical bullion like this, well, it's real. Physical commodity gold is real. Like you could even call this physical commodity gold. It's real. But intangible trading contracts and derivative contracts, those are the financial products, not wealth you can hold in your hand, not really even wealth that you can control, because you can only convert it back into this stuff that's dying. And in a crisis, the difference between the two becomes life-changing. So let's start with the most common trap. The products that look like gold, trade like gold, and price like gold, but are nothing more than paper promises, and barely, frankly, even that. Because GLD is one of the most widely purchased gold products in the world. But it's not gold. It's a share in a trust. You don't own the metal. You don't have the right to take delivery. You don't know the bar numbers, and you certainly don't control the custody chain. GLD is designed to track the price, the trading price, the COMEX price, that spot price contract of gold, not give you gold. That's why the chart looks similar. The price is exposure, but exposure is not ownership. And in a crisis, GLD can freeze, halt, or even fail to deliver because it's still part of the financial system. And when the system is in trouble, then products inside the system, they can't be the solution. The other thing that I want to point out to you are the fees attached with holding GLD, because every single day they sell off parts of their holdings to pay those ongoing fees. So when you're looking at the chart comparing GLD even to the spot gold contract, can you see how there's a division between the red, the GLD, and the blue, that spot gold contract? That is reflecting the fees. So the longer you hold it, even the less underlying gold that you actually supports those contracts. But you don't see that when you're looking short term. However, just like gold, silver comes in forms that look identical on a price chart, but behave very, very differently in the real world. Bullion, like this, well, it's real. It's commodity grade silver is real, but trading contracts and derivative contracts, well, those are those financial instruments, layers of promises stacked on top of each other. They can be created in unlimited quantities, but they can also be frozen, and they can be settled in cash instead of metal. The spot price you see here reflects all four categories blended together, which means that the price is influenced far more by paper trading than by physical supply and demand. And that's the piece, that's the transition that we're in right now. And that's why silver can be volatile on the screen while remaining scarce in the real world. Well, all right, so now that we've separated real metal from paper, let's take a look at the specific risks that are built into these paper products, risks that most investors never see until it's too late. So what you're looking at here is SLV. Now, while SLV, which is the silver ETF, and it moves like spot silver, trades like spot silver, and is marketed in a way that makes you think you own silver, but you don't own any metal. You don't own anything but shares in a trust when you buy SLV. You own You have no access to any of the underlying physical metals, no right to take delivery, and no visibility into the custody chain or what's really there. And in fact, you might recall this back in 2020 when the markets were again, both for spot gold and spot silver, going crazy and you could barely get it. SLV changed its prospectus so that all it really has to do is mimic the spot gold, the spot silver contract, because they couldn't even get their hands on enough physical to create the underlying baskets of SLV. It's structured simply to track the price of silver, not to give you silver. And just like any financial product, it can be halted, it can be frozen, it can be cash settled. So while the chart shows SLV rising with spot silver, it's structured to track the price, that spot price of silver, that contract, not to give you actual real silver. And just like any financial product, it can be halted, it can be frozen, or if they want to, they can cash settle it. So while the chart shows SLV rising with spot silver, the reality is that neither one of them actually represents real, tangible wealth. It's just that simple. And now that we've exposed the trust products, let's look at the next layer of illusion. Those contracts that promise silver that may not even exist. Because for years, people were told that silver manipulation was a conspiracy theory, gold and silver manipulation. Oh, yes. But the banks themselves proved otherwise. Of course they do. Here you're seeing, and it's probably much worse than what we're looking at, but 8 major institutions, all of the usual players, the biggest players in the global finance space, well, they paid over $1 billion in fines for rigging the silver market. Not once, not even twice, but over and over and over again across decades. And that little fine that they paid, oh, don't do that again. It's chump change compared to all the money that was made on all of this manipulation. And they weren't accidents. These were coordinated actions designed to distort price, influence sentiment, and protect the system. And even after those fines, well, as you can see, the behavior, it never stops because the penalties, like I said, they're teeny tiny compared to the profits. So when you see silver spike and you see it drop, when you see all of this volatility, it's in those contract prices. And it's not a surprise. It's what happens when manipulation finally loses control. And that's what we're seeing in the volatility because silver is the trigger. And now that we've seen how deeply the paper markets are distorted, let's look at what happens when physical demand collides with a system built on leverage and promises. Because we're talking about mining stocks. Mining stocks, well, they're often marketed as a leveraged way to own gold or silver. But mining stocks are not metal. They're corporate shares, and they're tied to management decisions, energy costs, political risk, environmental regulations, labor disputes, debt loads, and stock market volatility, to mention a few. A mine can be nationalized, a project can be shut down, a company can dilute shareholders or go bankrupt, and none of this has anything to do with the price of gold or silver. Mining stocks can be part of a strategy, but they are not a replacement for the physical metals. They live inside the same financial system we've been exposing, and that means that they can carry those same systemic vulnerabilities. Now, this chart shows a major breakout in the mining stock index. And yes, when gold and silver rise, when those contracts rise, mining stocks often rise maybe even faster. But that doesn't make them a substitute for physical metal. Mining stocks are still equities. They still trade on exchanges, and they're subject to margin calls, liquidity freezes, algorithmic trading, and broad market sell-offs. But a mining company can hit record profits and still see its stock fall if the overall markets turn down. Best day I ever spent as a stockbroker was 1987, when what I was told was rock solid in that 25% route wasn't so rock solid. And mining company stocks, frankly, they're not any different. And even in a breakout like this, shareholders don't really get any gold or silver. They get price exposure. Nothing more. Mining stocks can be a speculation, but they are not wealth insurance. So we're looking at all of these major illusions: paper metals, trust products, derivatives, and mining stocks. Let me give you this long-term comparison because I think it makes it very clear that mining stocks and physical gold do not move in the same way. And so what you're looking at is a comparison between that spot gold blue contract and that red contract, which are gold mining stocks. And so even up close, it looks like they're the same. They're not the same. And I hope you can see it in this comparison, because those are opposite conditions. It's why you see divergences, periods where gold surges while mining stocks lag, or where mining stocks collapse, even as spot gold holds its value. Mining stocks can offer leverage, but they also bring leverage risk. They're tied to the stock market, the credit markets, and the broader economy. Physical gold, physical silver stands outside of the system. Let's talk about that, because now we've separated a whole bunch of illusions from the reality, and it's time to focus on the only form of ownership that removes counterparty risk entirely: physical gold and physical silver in your possession. Because this is frankly where everything changes. The physical gold and silver markets operate on completely different principles than the paper markets that we've been exposing. Physical metal cannot be printed, rehypothecated, or digitally frozen. It doesn't rely on a counterparty. It doesn't need a promise to perform. It simply exists. And that's why it's preserved purchasing power for thousands of years, while every single fiat currency, government-created currency, has eventually gone to zero. When you hold physical gold and silver, you step outside the system. You hold an asset that is globally recognized, historically proven, and immune to the financial engineering that distorts every single paper product as it transfers your wealth their way. So I want to break down the different ways, the different forms of the physical metal, because even in the physical market, not all gold and silver are created equal, and they all have different purposes. So let's start with monetary gold and silver. Monetary gold and silver, well, they're some of the purest forms of money. The metals that have served as the foundation of every sound money system for thousands and thousands of years. They're durable, divisible, you can go to fractional, they're portable, and they're universally recognized wherever you are in the world. But because they're money, they've also been the target of governments during periods of financial stress. In the U.S., we saw overt confiscation in 33, in 71, and many other times, and covert with all of this manipulation. And the laws that enabled it, well, frankly, they were never fully repealed. Monetary bullion sits in the monetary category. That's what you can hold inside of an IRA. And that means that it can be pulled back into the system when governments need to regain control, regain your confidence, and reset all the collateral in the system. And that's why diversification within physical metals matters a lot. Monetary bullion gives you liquidity and universal recognizability, but it also carries the highest historical risk of overt or even covert confiscation. Other forms of physical metal, like collectibles, fall into a different legal classifications, which historically have been treated very, very differently. So understanding these distinctions is essential for being a truly resilient and properly diversified metals strategy. So we're going to look at all the different forms of physical metals that are available. Well, maybe not all of them. You could come up with some on your own. But why some offer not just monetary protection, because they all will offer that, but legal insulation and long-term wealth preservation. I am ever so grateful that I was born in 1954, and I actually lived through much of this myself, and it has absolutely influenced the way that I think about it. Because gold bars, they come in all different sizes, from 1 gram wafers all the way up to 1 kilogram bricks. Bars are efficient, recognizable, cheap, and cost effective for stacking weight, but bars also sit squarely in the monetary category. And that means that they fall under the same legal classification as bullion coins. The same category that was subject to overt confiscation in 1933. So bars give you purchasing power protection, but they don't give you legal insulation. And I know that there's an awful lot of hopium out there that, they would never confiscate again, except that we have done it so many times just in this country alone, let alone around the world. It's not a very good plan, and there is no foundational justification for people to feel that way. They just have hope, and to me, hope is not a very good plan. But this is also why diversification within the physical metals itself matters. Bars are one tool. If you want to stack them, that's fine. You just need to be properly diversified. You know me, I like to go, what if I'm right and what if I'm wrong? And if I can do something that it doesn't matter whether or not I'm right or wrong, that will always, always, always be the choice that I will make, because it's the one that protects me and my family the most. So while bars or even bullion coins are great for accumulating ounces, in my opinion, you do whatever you want. But in my opinion, they should not be your only tool. And as we move forward, you're going to see how different forms of gold and silver fall into different legal categories, and why certain forms historically offered far more protection when governments moved to control monetary gold. Yet again, and they are talking about it. And keep in mind that every single central bank has a gold revaluation account. They don't have it because they don't intend to use it, right? I want you to think about that, because we're going to be now looking at bullion coins. I get this question all the time. Well, what if I buy, a Philharmonic from a different country and I don't live there? Will that protect me? No, bullion coins are also very recognizable, and they are physically a form of gold in the world. And every major country issues them. In Canada, it's the Maple Leafs. In the U.S., it's Eagles, et cetera, et cetera, et cetera. They're trusted. They're liquid, easy to buy and sell, and easy to verify. But bullion coins sit in the same legal category as the bars do. They're monetary gold. And that means that they carry the same historical vulnerability to over-confiscation if they're new coins. In 1933, bullion coins were explicitly targeted, and the legal framework, frankly, that allowed that, it still exists today. They did not negate every single law, especially the Trading with the Enemy Act. That is fully in force. Let's take a look at the category that historically offered the strongest protection. The form of gold that was exempt from over-confiscation and treated as private property rather than monetary metals. And that's the collectible category. I remember my Uncle Al, right? I mean, this had a huge influence on me. 1964, we are at his house. He says, come on, I want to show you something. We go in his back bedroom. My parents and I go in his back bedroom. He had 2 tall floor safes. He opened the doors on these safes and he said, if anything happens to me, Aunt Bertie will be well taken care of for the rest of her life because of what's in these safes. So I turned around and looked, and you couldn't fit one more pre-1933 coin in those 2 safes. Knowing what I know now, I'm guesstimating that there were at least 3,000 ounces of gold in those safes when it was illegal to hold it in any other way more than 5 ounces. But that's not entirely true, so I'm going to show you the different ways that you can hold it, because this is also jewelry. This gold necklace that I personally bought in 1987 for about $350. I brought a scale today because I want to show you some things that I think you're going to find very interesting, and we'll take a picture of this afterwards, right? Okay, now this is Italian, it's 18 carats, and let's just see how much it weighs, because I paid $350 for it in 1987. This is 1.6 ounces, and the most recent appraisal that I got of it, and this was before spot gold and silver's run, was $6,500. There are additional layers of protection, but quite honestly, even just at the gold content weight, it has protected my purchasing power all those years. Another one I want to show you, because you can see all the forms, and of course you guys all know my junk silver, right? Little sterling silver, 92.5% pure. But you guys remember not that long ago when I went to Malaysia and Cambodia. And this is one of the souvenirs that I brought back because they do such gorgeous sterling silver work. This is a sterling silver belt. At that time, and this was in Cambodia, I paid, I think about $310, $320 for it, something like this. And it's a beautiful belt. The workmanship on it is phenomenal. Oops. And it weighs 10.6 ounces. So even if we take away all of this phenomenal work, what do you have? You have monetary gold at its base, which is more than doubled from the price that I paid for it when I bought it. Because it isn't silver or gold going up. It's the value of this stuff going down. That's what the markets reflect. Well, that isn't really what the markets reflect. That's what the spot markets are attempting to reflect. But it isn't revealing the true fundamental value of any of this gold and silver. What I'm showing you are all different ways that you can hold it at any level. And keep in mind that it does not need to be even in great condition. It can be bent, it can be broke, it can be tarnished, like, you know, all of this junk silver, all these sterling silver forks and iced teaspoons and stuff like that. Just remember, gold and silver in any form is monetary at its base. But the difference between, say, this bullion coin here and my pre-33, or even this belt or the jewelry or the things that you're seeing on here, is the layers of protection, because this This is private property. It is in a different classification. I cannot hold any of this inside of an IRA, that or a retirement program for wherever you are in the world. If you can hold it inside of a retirement program, it is more than likely classified as monetary gold and monetary silver. If you can't, personally, that's what I like to hold, because it doesn't matter. I could be right or I could be wrong, but I get to keep it. I get to keep it. And because I am crystal clear on the true fundamental value of an ounce of gold and an ounce of silver in terms of this fiat stuff, then I eat up all of the fees, any costs, any penalties, all of that. Because what you're really doing is buying a long-term positive trend in an undervalued asset. Why is it undervalued? Because a rising gold price is an indication of a failing currencies. Do governments really want you to understand that this stuff is just garbage, not even worth the paper that it's printed on? No, they don't want you to know that, because once you know that, once you realize that what you're really working for is corporate debt and there's no difference between these two monopoly money or my $10 trillion Zimbabwe note, the only difference is at one point, this was actually accepted as money. No more. No more. I can't buy anything with this, even though I'm a trillionaire. And I can't buy anything with this, but I can have fun because I can play a game with it. So my point is there's gold and there's gold, and there's silver and there's silver. Do you want those layers of protection? And even if you say, nah, I just want to keep stacking, well, then wouldn't it make some sense to properly diversify your portfolio? So if you're going to have a stack of bullion, have a stack of collectibles to offset it, just in case they do what they've done so many times before. They will do it again. This is not different. They're setting up for it. You want to be out of that loop? Hold it, own it, in lots of different forms. And we're here to help you do that. So give us a call and we'll set up your personal sound money strategy to support you so that you can sustain a reasonable standard of living today, be in a position to take advantage of the opportunities that always present during these transitions, and come out the other side of it in a better place. But primarily, we need to get redeemable gold back in the system again. And we can if we come together and we demand it. They're not going to volunteer it because they want to keep the power. I say we need to take the power back, and we can do it together. And until next we meet, please be safe out there. Bye-bye.